The investment planning domain represents approximately 17% and focuses on the principles, strategies, and analytical methods used to build and manage investment portfolios. This domain prepares CFP professionals to help clients achieve financial objectives through informed investment decisions aligned with risk tolerance, time horizon, liquidity needs, and financial goals. Investment planning requires understanding financial markets, economic conditions, investment vehicles, and portfolio construction techniques. Candidates must also evaluate taxation, market volatility, diversification, and behavioral influences affecting investor decisions. The goal of investment planning is to balance risk and return while supporting broader financial planning objectives, such as retirement security, wealth accumulation, education funding, and estate preservation. Investment vehicles are financial instruments used to generate returns, preserve capital, or provide income. CFP candidates must understand the characteristics, uses, and taxation of common investment vehicles including stocks, bonds, mutual funds, exchange-traded funds, options, real estate investments, and retirement accounts. Each investment type carries different levels of risk, return potential, liquidity, and tax consequences. For example, stocks may offer long-term growth potential, while bonds typically provide fixed income and lower volatility. Tax treatment also varies significantly among investment products, affecting after-tax returns. Financial planners must evaluate these factors carefully to recommend investment solutions that align with client objectives, risk preferences, and broader financial planning strategies. Understanding investment risk is fundamental to effective portfolio management and client suitability analysis. CFP professionals must identify and evaluate different types of investment risk, including market risk, interest rate risk, inflation risk, credit risk, liquidity risk, and business risk. Investment risk refers to the uncertainty surrounding future returns and the possibility of financial loss. Financial planners help clients understand how risk tolerance, emotional behavior, and financial capacity influence investment decisions. Effective risk management involves balancing potential returns against acceptable levels of volatility and uncertainty. By properly evaluating risk exposures, financial planners can design portfolios that support client goals while minimizing the likelihood of inappropriate or emotionally driven investment decisions during market fluctuations. Market cycles are another important concept within investment planning because financial markets move through recurring periods of expansion, contraction, recovery, and recession. CFP candidates must understand how economic conditions, investor sentiment, monetary policy, and business activity influence market performance. Market cycles affect asset prices, interest rates, inflation expectations, and investment opportunities across different sectors. Financial planners use this knowledge to help clients maintain disciplined investment strategies during changing economic environments. Understanding market cycles also reduces the likelihood of emotional investment decisions driven by fear or speculation. Long-term investment success often depends on maintaining consistent strategies and avoiding reactive behavior during periods of market volatility and economic uncertainty. Quantitative investment concepts and measures of investment return provide the analytical tools used to evaluate portfolio performance and compare investment opportunities. CFP professionals must understand concepts such as rate of return, standard deviation, correlation, beta, alpha, present value, and compound growth. These measurements help planners assess risk-adjusted returns, evaluate diversification benefits, and estimate future portfolio performance. Candidates must also understand the relationship between risk and return, recognizing that higher potential returns generally involve greater uncertainty. Quantitative analysis supports evidence-based investment recommendations and allows planners to explain investment outcomes clearly to clients. Mastery of these concepts enables financial planners to make informed portfolio decisions grounded in financial theory and practical analysis. Asset allocation and portfolio diversification are central principles of modern investment management. Asset allocation involves distributing investments among asset classes such as stocks, bonds, cash equivalents, and alternative investments based on client objectives and risk tolerance. Diversification reduces overall portfolio risk by spreading investments across different securities, industries, geographic regions, and asset categories. CFP candidates must understand how diversification lowers unsystematic risk while improving portfolio stability. Financial planners regularly rebalance portfolios to maintain alignment with strategic objectives and changing market conditions. Proper asset allocation is often considered more important to long-term investment success than individual security selection because it determines the portfolio's overall risk-return characteristics and long-term performance consistency. Bond and stock valuation concepts help financial planners evaluate whether securities are appropriately priced and suitable for client portfolios. Candidates must understand valuation methods such as discounted cash flow analysis, dividend discount models, price-to-earnings ratios, yield calculations, and bond duration measures. Stock valuation focuses on estimating a company's future earnings potential and market value, while bond valuation evaluates interest income, maturity value, and sensitivity to interest rate changes. Portfolio development and analysis combine these valuation principles with client objectives to create diversified portfolios aligned with long-term goals. Financial planners continuously analyze portfolio performance, risk exposure, and investment suitability to ensure recommendations remain consistent with evolving client needs and market environments. Investment strategies and alternative investments complete the investment planning domain by addressing advanced portfolio management techniques and specialized asset classes. Investment strategies may include active management, passive indexing, growth investing, value investing, dollar cost averaging, and tax-efficient investing.